Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. Managed money has largely been responsible for the strong run that we've seen in the commodity markets, and that can best be seen by looking at the CRB Commodity Index. In this chart, we can see from early January that the commodity index itself put in a very significant low early in the year, about in the middle of January, and has been running up since, and is just now meeting potential resistance near 2,600 or so. As we look at this index, it's important to understand the nature by which we want to view the markets. Even though the backdrop or the narrative of the markets themselves have been quite bearish, the filter through which we view the markets is also very important to help us understand how the markets could potentially move. Two key levels I want to bring to our attention on this chart are both the 2235 level as well as the 2330 level. These two levels, I believe, was a key demarcation point for the managed money positions. Once the market was able to clearly get above these levels, we saw record numbers of net long positions starting to be added to portfolios. Part of why this market was able to run up in the fashion that it did was primarily by the high weighting that crude oil weighs on the CRB index itself. Once crude oil bottomed, what we saw is an effect where the crude oil market itself really pulled the rest of the commodity markets with it, bringing all of them higher. And so thereby, it's important when we view the markets to understand the filter by which managed money is making their decisions. A handful of key demarcation levels I want to bring to our attention if we're going to continue to monitor the CRB index. If and when the market's able to get to about 2800 or 2810, I believe that looks to be a significant area of resistance if it's even able to get up there. The next level of significance is going to be the 2667 level or the 2666 in that range. Both of these areas should pose significant resistance the first time the market makes an attempt there. And currently we can see at the 2604 number that the market, when it first met it there last week, also found some good resistance there and has since backed off and is possibly responsible for some of the softness that we have been seeing in the markets themselves. Normally we take a look at the crude oil market at the tail end of our presentation. Today let's take a look at it a little bit early because I really believe that the crude oil market itself continues to play a key role in the CRB index as well. We've previously talked about a potential topping formation occurring here in the actual crude oil market itself. And as you can see, it recently topped near our timeline. But we also have found very good support right around the 47 number. If this area near 47 continues to hold, there's still a very good chance that the market can make one more final run up to about 53 to 54. And upon doing so, we believe that this stands to be a very good area for this final top to occur, where we can then see a summer downdraft in the crude oil market itself. Now, this particular contract is coming off the board in the not too distant future, so we'll be translating this information over from the July contract onto the August contract. So the correlation that we're seeing here is important to understand the nature of what is now ahead of us. We have a couple key components that we want to keep at the forefront of our study. As we look at the CRB index, that's going to play a role or a factor in managed money's decision as to where they're looking to take profits and to lock in some of the gains that they've been able to see over the past few months. Secondly, as we transition over from El Nino over to La Nina, some of the weather patterns that we're seeing are also going to play a key role as to whether or not these prices are sustainable in the commodity markets overall. So as we look at corn and soybean in particular, the months of July and August are going to be very important as we look at weather factors in terms of how they look to impact the crops. Looking at the July corn contract, in our most recent newsletter, we suggested that corn was looking to be sideways to slightly up through the end of the month, and so far it's actually working out pretty well. We've had great resistance at the 433 half number, and above there about 450 is about as high as we believe the market will probably reach with the last few weeks left before first notice date. Upon finding key resistance, the corn market itself would perhaps top going into the end of the month. We're looking for the month of July to be a timeline where prices really decline, barring weather changing the dynamic of the actual seasonality of what corn typically does during this timeline. Today, the markets have been hugging near the point of control, which sits at 433. One standard deviation above that level is 475 and a quarter. And another level above that is about 502 half. We don't believe that we're going to get to either one of those two standard deviation levels, but it's important to notice here how the market is starting to oscillate around that point of control. That gives us confirmation that we've seen quite a bit of volume at price near that price threshold, and then we can see a vacuum of either side. We're also noticing that we have very good resistance along this natural trend line here, and so the market really would need to make a nice clean break above this area to go test that 450 number. But as long as it finds resistance against this natural trend line, we could continue to see markets just simply moving sideways ahead of the month-end timeline for a potential turn. The December corn contract has been tracing out a very strong and very nice upward curving uptrend here. And as it's met the 447 resistance level we talked about last week, here markets have been pausing just a bit. If it's able to find strength above this 447 number, we would look for the next key resistance to come in at about 468 half. And those are going to be the two very important price levels that we'll continue to monitor for this contract. Below we have 426 as potential support, and breaking back below there we could see prices come back down to about 406. The point of control for this December contract sits at 420 as it did last week. One standard deviation above is at 453 and a quarter. That 453 that 453 price range should pose significant resistance overhead. But if it's able to break through there, then again, as mentioned before, we'd be looking for prices to maybe inch its way up to that previous level we talked about at about 469. Our models pointed to a potential top occurring in soybean either on Friday of last week or early this week, and so far so good. On Friday, as you can see in this actual chart, the market put in a very nice little topping formation here, giving up much of the gain from the day and closing close to the lower end of the day's range. That was right up against our 270-degree mark of 1212 and a quarter, and that's where we found very good resistance. Since then, the market has been moving down over the past couple days as anticipated, and so now a break of 1143 would be a key demarcation level for potential weakness for a move down to about 1110. Until then, we're not going to necessarily jump the gun, but much of what we're seeing right now is potential profit taking on the part of managed money. We've seen a very nice run up in the markets, and we're also in the midst of rollover from the front month contract to the deferred. And so some of that is also playing a role in the added weakness that we see in the July contract. Overhead, we can see that key resistance came in at about 1210, right against our natural support and resistance levels that we can see here. And so until he can get back up and break above this 1210 number, we continue to anticipate a potential continued decline for the July contract. Likewise, the November contract has been responding very well to our natural support and resistance levels. At the 180-degree mark of 1188 above, you can see the market found very good resistance. Went up to that point, and at the first approach, then reversed and came right back down. We've now traveled through the 1153 half number, and the next key support number we're looking at right now is 1119 and 3/4. Below 11.19 3/4, we'll probably see a very good run to the downside, at which point we're probably going to start seeing some triggers occur for managed money because the narrative of the supply is still borderline. Even though last week's USDA report had some hints of bullishness, the managed money is going to be cautious here to not give up very good profits that they've seen. For this contract, 2 standard deviations above the point of control is at 11.54. Current price is at about 11.44. And so what you'll notice here is the market has found very good resistance right up against 2 standard deviations above that point of control. It made its mark all the way up to about 11.85, almost 11.90, but you can see here this reversal occurred at the top of the market right up against our natural resistance level here. Market has since come back down, and so for him to garner some strength, we're going to need to see him get back above that 11.54 number. Outside of that, we're then looking for markets to potentially continue tracing down. Last week we warned that wheat stood to reverse and come back out of the recent highs that it had just as it did before. That's exactly what we were seeing occurring here. The markets come in and it's had very strong days down after making that high up against volatility-based resistance just past the 504 to 510 numbers that we talked about previously. The markets come down, is really having a tough time. Again, the supply of wheat has been very strong, but at the same token, what we've noticed is wheat has been a drag on corn as well. Because wheat can be substituted as feed for corn, instead of allowing corn to run up in conjunction with the soybean run that we've seen, wheat has played a role of really muting the ability for corn to really rise up rapidly. But at the same time, we're also seeing that the oversupply in wheat also has its own share of issues with being able to maintain a strong run. We're now back down below the 487 key resistance point that we've seen in the past. And again, as long as he stays below this 482 to 487 number, we continue to anticipate continued weakness. Above, he can potentially have continued strength. Currently, prices are sitting at 481 1/4, just below the 482 half point of control. And as we can see, just as before, the market's really having a tough time holding its gains. And the last time that it made a run up inside this area here, back in early April, or rather back in late April, we're noticing that he's having a similar movement and having difficulty in holding it. Just as he found great resistance up against our natural angle here, again, against this natural angle is again where he found another set of very good resistance before moving its way back down again. As this market continues to trail down, if it gets back below this 457 3/4 number that we talked about in the past, we anticipate it can reach 447. Now, this contract's coming off the board in the not too distant future. With first notice date coming in on June 30th, we're going to be rolling over the analysis onto the upcoming contract as well for this guy. Thank you so much for joining us for our weekly market update. Look forward to touching base with you again in the not too distant future.